You just mentioned. Big news, and not the positive kind, for Uber out of London. Uber suffering a blow to its operations. Drivers there not going to be classified as self-employed contractors. They're going to be classified more like employees, meaning Uber's got to be making sure they're making minimum wage and that they get time off, among other things. Jason Calacanis, early Uber investor, joins us now.
Great to be here.
Jason, it's looking tough for Dara, the new CEO. One of the first things that he said he was going to do is go over to London and make nice. How's it going?
Well, you know, the apology tour continues, and I think it's going to take time. This issue is very specifically around the independent contractor designation. And many of the Uber drivers want to change the number of hours they work. They want to work 10 hours one week, 40 hours another. And in every location, there's a different set of rules. So in London and in the UK, there's a totally different set of rules than here in the US. And it's just a financial equation in my mind. If a location wants to classify these as full-time employees and reduce their ability to have flexibility, then it's just going to increase costs for the consumer. And it's just the nature of different markets, different regulations. And I feel here in the United States, we need a third classification, not an independent contractor, not a full-time employee, but somebody who is part of the gig economy, and that they get some sort of credit towards health care and maybe some number of days off, while still being able to change from 20 hours a week to 60 hours a week as they feel. So I think that we just need to learn how to handle this new gig economy, and it's going to take some time.
That got talked about a lot during the election. During the primary season, especially. Jeb Bush went out to Silicon Valley, and Hillary Clinton talked about it.
He hit me up on Twitter.
We haven't heard a lot about it in the past year.
Well, I mean, here's the truth. In a competitive, market like today for talent, the market is actually driving wages up. We see that, and we see a lot of locations putting a $15 minimum wage. So the drivers are going to move from Amazon to Lyft to Uber, or whoever gives them the best deal. There is a massive competition, and a lot of the startups I invested in 3 or 4 years ago died in the on-demand space because they couldn't keep up with what Uber, Lyft, and Amazon were willing to pay. So I think the market forces are at work here, and we're seeing the minimum wage go up and the net hourly rate go up. And, the truth is, people want these type of jobs. Millennials and then older people, or the second income in a household, they want that flexibility. They want to be able to drop their kids off at work for 4 hours, and then come back off of it. So the market will decide ultimately, and regulations need to evolve on the margins. But net, look at America. We have some of the greatest unemployment. That we've lowered unemployment very significantly after that Great Recession. So I feel good about what Uber and Lyft have done for the economy.
What about Dara? It was interesting to hear from him at the Deal Book conference yesterday, talking to Andrew. I knew you would react that way. On track, he says, for 2019 IPO. He says Travis and the whole board is into that idea, and that he has a good relationship with Travis Kalanick. Did that surprise you?
Yeah. Well, Travis has evolved, I think, and learned a lot. I think he's done a tremendous job getting the company to where it is. And now you have Dara coming in, who has this other skill set and is really fixing things up and getting us on a very clear path towards an IPO. And there's this other optionality, the Masa IPO. In Silicon Valley now, everybody's talking about why IPO when you can just Masa PO. We're just Masa's gonna save all these companies to put the money in, and we're good.
Yeah.
So I feel great about it. I mean, listen, we have this incredible optionality.
It's a question of who he's going to hit with that wand, though. Is it going to be Uber? Is it going to be Lyft? He doesn't hit everybody. Well, we've got to move on and talk Disney. Reporting results yesterday, missing estimates on earnings and revenue, but still, the stock's higher after CEO Bob Iger announced plans to take on Netflix. Take a listen.
We've given a lot of thought to pricing, both the ESPN and the Disney branded service. And I can't get specific with you yet. We haven't actually officially determined it, but we said we will be forthcoming with you on this sometime after the first of the year. I can say that our plan on the Disney side is to price this substantially below where Netflix is.
Sounds like a boutique streaming service, not the grand unified vision, Jason, that you suggested. What's your take on Disney's at least initial foray into streaming?
I think Disney is going to become a juggernaut. They could eclipse Netflix or be on par with them. Ultimately, this may take 10 years to play out. But if you look at what Disney does incredibly well in those parks, they know how to sell direct to consumers in those parks. We've all been there. We've all, spent hundreds of dollars a day in that park. They have a discipline of selling into the distributors when it comes to content. But they have this massive content library. When they dial it in and they're going direct to consumer, as we talked about, I think 2 years ago on this program, when they start selling direct to consumers, they're going to be able to take this 27 movies I think they've done for Marvel and then do the Star Wars live action. Right now, my 8-year-old is getting into Marvel, and we're watching every Marvel movie, and it's like, where is the Marvel movie? If I could pay $7 a month to Disney and not have my 8-year-old on my shoulder saying, put on Hulk, put on Avengers, and just get it all in one place, fantastic. And then you look at YouTube and their horrible missteps with taking no ownership of the content on YouTube Kids with this disturbing content. I think this is going to play into Disney's hand amazingly. Now, ESPN is a bit of a challenge because they cannot charge $7 a month for that direct to consumers and make that work, especially not with like the massive contracts they have with the sports league. So I think that's going to be a challenge, but I could see Disney immediately getting to tens of millions of people on this service, and consumers are going to flock to it. Pixar, Star Wars, and Star Wars is really cranking. I mean, Rogue One was the #3 Star Wars film of all time. It's Empire Strikes Back, Star Wars, Rogue One, Return of the Jedi.
You think Disney disrupts Netflix here?
I don't think it disrupts it. I think it's going to be an equal competitor ultimately. If I gave you $1 million right now and I said, place your bet, what amount of money would you put on Disney? What amount would you put on Netflix? At this point, I would put 50-50. And if you asked me 3 years ago, I would put 100% of it on Netflix. But Netflix has had a tremendous run-up, and I think they're going to hit, 100% penetration, and then they're going to lose everything from Disney, everything from Pixar, everything from Marvel. So all this Daredevil content that they've got, all this incredible content, I mean, this is the yum content that they can't live without, is gone.
Well, this is not the last we're going to hear from you.
No.
On this or any other subject. Jason Calacanis, it's always great to have you here on SquawkAlley. Jason Calacanis.
Don't at us.
Inside.com.